Chinese e-commerce company Alibaba is set to report earnings Thursday before the opening bell. So joining us now to preview those results is Hottovy, strategist at Morningstar. RJ, great to speak with you this morning.
Yeah, thanks for having me.
So after Alibaba raised a record $25 billion last year when it went public, its founder Jack Ma warned about the danger of high expectations. Now since then, what's your expectation for growth? What's changed?
I think that our expectation for growth is still pretty healthy for this company. Not only is it the Chinese e-commerce still at pretty early stages of growth, but they've just started to tap some of the tier 3 and below cities in China. I think there's a lot of demand for branded products in those regions, and without the established retail framework that a lot of developed countries have, I think e-commerce is going to fill that void. Still pretty optimistic about the longer-term growth expectations of this company. We forecast an average annual growth rate of around 30% the next 5 years. Obviously a little bit higher the next couple of years and a little bit lower in the later years. But still generally a lot of white space for this company to grow, particularly in China.
And I want to talk about some of the tailwinds that you mentioned in your latest research note. You mentioned China's middle class income growth. What is your outlook on the so-called tailwinds?
Yeah, so I mean, right now you're talking about a Chinese consuming class that's going to effectively double over the next, next 10 years or so, from 300 million individuals to 600 million individuals. Yeah, that to me, and a lot of that being fueled by state-mandated wage growth. I think that's going to give a lot of discretionary spending power to the lower to middle income consuming group, and I think that e-commerce should benefit from that. I think that's one of the key drivers doing that. The other thing that we're seeing right now is urbanization trends. So more and more consumers moving to urban cities, taking higher paying jobs instead of farming and other more rural positions. That also is going to have a meaningful headwind. And the other thing too is we're talking about a population that is really starting to come into its own in terms of family creation. That's going to create a lot of new demand for online purchases. I think that's also a tailwind to keep in mind when looking at the China economy.
Yeah, and certainly those are all, I would say, probably longer-term positives for a company like Alibaba. Let's talk about specifically what investors should be looking at or looking for in tomorrow's earnings report, especially in light of the fact that the stock is down more than 20% for the year.
Yeah, sure. I mean, I think there's a few things that are probably at the forefront of investors' minds right now, and obviously the stock has pulled back quite a bit the last month or so. I think the first thing people are looking for is the monetization rate, so effectively the revenue that they're taking in from the gross merchandise volume that they're selling. They've made some changes to the way the advertising platform works, the pay for performance, the cost per click changes. That could be something that disrupts the monetization rate. I think that'll be a key area that investors focus on. Probably going to be down from a year ago because of some of these changes. If it's only down a little bit, I think that the market will be okay with that. If it's down substantially, the market will certainly react negatively to it. The other thing I think that the market's looking at here would certainly be any indications of deceleration in the Chinese GDP, if that has any impact on the overall e-commerce market. And then the last thing is that there was an internal memo from Jack Ma that made its way to the market last week talking about a hiring freeze within Alibaba and expenses are growing too fast. And I think the market needs clarity on that. For a company that's growing fast, is this an indication of slowing growth, or if this is just better management practices and keeping costs contained? I think if we get a little bit more clarity on that, I think that's something that the market could actually positively react to if it's just normal course of business. And
RJ, just real quickly, in light of all of this entire discussion, where do you stand on the stock right now?
Right now, I think it looks fairly undervalued. We've got a $90 per ADS fair value estimate with shares trading at 80. I think it could be an attractive point. I think there's a lot of negativity built into the stock right now, and so all it would take is a little bit of positive news to get this thing going again. So it might be worth a look at current levels.
Well, Hottovy, thanks for joining us today ahead of Alibaba's earnings Thursday morning. Thank you for watching. I'm Morgan Brennan. Have a great day.
Hey YouTube fans, I'm Landon Downey from CNBC. Thanks so much for checking out our channel. Here you'll find videos packed with all the info that you need to be smarter about your finances. Be sure and subscribe by clicking right here and click on all the videos around me to see CNBC's original series Young Money, Tech Bet, Cramer's Mad Money, and all the latest from CNBC.